In this presentation, we will take a look at part one of an example problem related to a public university, this time recording transactions, financial transactions for the public university example problem. As we go through our transactions, we're going to have the trial balance on the right. We're going to have the information up top. We're going to be recording the journal entry down below. The trial balance will be in order. We have the assets up top, then the liabilities in orange. We have what would be the equity section in a for-profit type of organization being the net position section here in our public university. Below that, we have what would be the income statement, those temporary accounts, income and expense, revenue and expense type of accounts, those types of accounts that would close out to the equity section in a for-profit organization, closing out here to the net position section. We're then going to create our journal entry and post them to our trial balance worksheet. First transaction, we have the billed tuition and fees. So we're going to bill the tuition and fees for the university. We will be recording these transactions as basically group transactions for the entire time period so that we could see the kind of transaction that would happen, record it basically in bulk for the entire time period to get an idea of it, work through a problem in an efficient amount of time, and concentrate on those items that would be different in a public university as compared to those that might be there for-profit organization. So we're going to have the billed tuition and fees. This is going to be similar to if we were to invoice, say, customers in a for-profit type of organization. If we billed them, we haven't got the money yet. Therefore, the asset's going to be going into an increase of the receivable. We will be tracking the receivable. The other side typically going into some type of revenue account, which we're going to call here the tuition revenue, revenues, tuition, and fees. So we have the debit to the receivables. However, we're going to be reducing it by the amount of scholarship waivers. So if there's a scholarship, then obviously we're not going to collect on it because there was the scholarship. We're going to reduce the receivable by that. Therefore, the receivable is the $1,467,000 minus the $245,000. Then the credit is going to go to the full amount that we billed for tuition and fees. We're going to say the $1,467,000. The difference between the two then is what we're going to record in tuition and fees, discount, and allowances. So let's see what that looks like when we post it out. We're going to say, of course, that the receivables will increase. Receivables here, that's going to go up in the debit direction as we would expect. The revenue is going to be going up for the tuition as we would expect. So revenue then is increasing. However, it's increasing for the full amount, even though we know we're not going to get money on some of it. Instead of decreasing revenue for the amount of the scholarship waivers and reducing the revenue account for that amount, we're creating another account, which is going to be basically a contra revenue account, it being called tuition and fees, discount, and allowances. It has a debit balances, acts kind of like an expense in that it goes up in the debit direction, bringing what would be similar to the net income number, as we can see here, down. But we're not going to reduce, in this case, the revenue account for it. Next transaction, we have the unearned revenue is earned during the period. This is going to be similar to a for-profit type of organization, in which case where we have money that has been received, or some possibly in the case of a public university, some type of action that has taken place where we had to record the receivable, but had not yet earned it, and therefore couldn't record the revenue on the other side of the transaction. So if we had cash, but we didn't earn it yet, we would have to record it in the unearned revenue. This unearned revenue then represents some kind of asset that has been recorded for a transaction in the past for which we have not yet done the work and therefore haven't been able to record it as revenue. Now we're saying that we have, so this credit here needs to go down. This is an unearned revenue liability account. We will debit it to make it go down. We're going to credit then the revenue, tuition, and fees to increase it, now recording the revenue, increasing it in the credit direction. So here we have that unearned revenue then going down to 0. We have the revenue, tuition, and fees going up in the credit direction back to 0 because the debits equal the credits. We see then that the effect on what would be similar to net income being an increase in the net income amount. Next transaction, we have a notice received from the federal government that funds may be received in the current year for costs incurred in creating student grading criteria. That's going to be for $58,000. Now here, this is going to be where there's no entry here because of the conditions of this particular item. Notice it's saying that we're going to reimburse possibly up to $58,000 if you have costs that are going to be related to this specific item. So if they were to have given us or promised to give us already the money and then put a restriction on it, in that case, we would record it in that instance. However, we haven't incurred the costs yet. They're basically saying, hey, it's possible to get the $58,000 reimbursement of costs if you then if you make costs related to this particular item. So therefore, there's no transaction here. That's going to be duly noted. We may then have the costs in the future. Once we then incur those costs, we can then petition and look for and get the grant money to reimburse for the costs that would be spent under the specific criteria, in this case, the student grading criteria. Next transaction, received unrestricted appropriations. So unrestricted appropriations, we're going to get the money for it. Therefore, cash is going to be increased. The other side is going to be some type of revenue account. The revenue account here being revenues, we're going to say they were state appropriations. Posting this out then, we're going to say cash is going up. We see cash up top has a debit balance. It's going up in the debit direction. The other side, revenue type of account. We have revenues for the state appropriations. It then goes up in the credit direction. The effect on the net income is, of course, an increase in the credit direction. Next transaction, purchased equipment with cash. So we purchased equipment with cash, straightforward transaction. This is the same as we would see in a for-profit type of organization. Obviously, the cash would be going down because we purchased the equipment for cash. Cash is a debit balance. We'll make it go down by doing the opposite thing to it, a credit. Instead of debiting an expense, like equipment expense, we're going to put it on the books as an asset, and then we will depreciate it over time, allocating the cost of it in accordance to the time period that we've used it is the concept for that. We're going to be debiting here capital asset to represent the asset account. So if we report that out then, if we post that out, we're going to debit the capital asset. Up top, we have the capital asset has a debit balance. It's going up in the debit direction to the ending balance. The other side then going to cash. Cash going down with a credit. Cash is a debit balance. We are crediting it, making it go down. Next transaction, cash contributions from alumni. So we have cash contributions from the alumni of 828. Amount that needs to be used for a construction project, we're going to say is 100,000 of that. Now this is going to be a little bit different than we've seen for other types of non-profit type of organizations, in that we will be looking at this 100,000, but not till we basically do the closing process. Right now, we're going to record the 828. You'll note that the accounts down here do not generally have anything that's saying that this is going to be with restrictions or without restrictions, as we've seen for other nonprofit organizations, although we do have that breakout within the net position, rather than net assets, net position section up top. So up top, we have that within the net position. We will allocate those out when we do basically the closing process. Therefore, here, we're just going to simply debit the fact that we got the cash, $828,000. We're going to credit the revenues to the gifts and grants of the $828,000. Posting that out then will look like this. The cash will be increasing in the debit direction, cash going up, the other side going to revenues, gifts, and grants down below, increasing in the credit direction, that then increasing what would be similar to the net income type of account as well. Next transaction, interest expense on bonds paid. So this would be very similar to a for-profit type of organization as well. We're going to be paying off the bond interest. So we're going to say that the cash then is going to be going down because we're paying it off. This is a bond payable on the books. As you can see here, we're paying the interest related to it. Cash then going down, the other side being the interest expense. So if we post this out, we're going to say, all right, cash is going to go down with a credit, decreasing the cash. The other side going to interest expense. Has a debit balance, it's going up in the debit direction, that then bringing down what would be similar to the net income number. So the net income type number then decreasing. Next transaction, Student tuition refunds made of the $119,000, we're going to start there. So we're going to say that we're going to give back basically cash because we had a refund of the cash. If you think about the transaction that we got the cash for, it would be a debit to cash and a credit to revenues, tuition and fees. We're in essence going to reverse that. So therefore, the cash is going to be going down. We're going to credit cash. We're going to debit then the revenue, tuition, and fees. So if we see what this will look like then, we could say, okay, cash is going to be decreasing. Cash has a debit balance. We're going to credit it, making it go down. The other side then going to revenues, tuition, and fee. This might look a little bit funny because although it's reversing and makes sense that we're reversing exactly what happened as we have the refund, it's not something we typically do in a for-profit type of organization. If, for example, there was a return in merchandise for a for-profit organization, we typically record the return not as a reduction of sales, the revenue or income account, but have another kind of account that we would call allowances of some kind, increasing like an expense, decreasing net income. Here, we're taking it directly to basically the revenue account, decreasing the revenue account. Again, makes sense. We don't typically reduce the revenue account most of the time in a for-profit organization. We then have cash collections of tuition and fees of the $1,538,000. The amount of that's going to be applied to next semester is going to be the $141,000. So what we're going to say is that this cash collected, the $1,538,000, is for things collections on account. So the on account accounts receivable typically going down, except for the amount of the $141,000, which isn't in accounts receivable. It's actually for the next semester, which we have not yet done as of now. And therefore, we can't record the revenue because we haven't earned it. We'll have to put it into some type of unearned revenue. And then we have investment income earned and collected of the $9,000. So of these amounts, this is all basically cash collections. So cash is going to be increasing with a debit of the $1,538 plus the $9,000. That's going to be the $1,547,000. So we debit the cash for the $1,547,000. Then we're going to say that the receivable is going to be decreasing. So the account amount in the accounts receivable here is going to go down by the $1,538 that we got minus the $141,000 that's going to be due for next semester. So the cash we got, $1,397,000, is going to be reducing the receivable. Then we're going to say that the $141,000, we got the cash, but we had not yet earned it. We got the cash, but we have not yet earned it. That's going to have to go to a liability account because we cannot record the revenue until we have earned it in accordance with the revenue recognition principle. Therefore, we're going to be crediting the unearned revenue. So that's going to be a credit to unearned revenue. Then we have investment income and collected. We had investment income collected, earned, and collected. That means we're going to be debiting cash and we're going to be crediting some type of revenue related to the investment. We're going to call that revenues investment income. So this transaction, we're going to record this then. We say that the cash up top, we've got the debit balance in cash. We are debiting it, making it go up in the debit direction. Then we have the accounts receivable up top. Accounts receivable has a debit balance. We are crediting it, making it go down. So we've made the collections there. We have the unearned revenue. It was at 0. It's going up in the credit direction. We have not yet earned it. It's a liability until we do so. Once we do so, we will reduce this liability and record the credit to the revenue account. And then the other side of the revenues for the investment income then going up in the credit direction. We could see the effect on what would be similar to the net income number is going up here by the $9,000, the investment income. The other accounts, of course, being up top because we didn't earn the cash we got now for the receivable. We earned it in the past. Now we're simply collecting on it, and we have not yet earned this amount yet. We're going to earn it, although we got the cash. We haven't earned it. We're going to earn it in some point in the future when we actually provide the education that has been paid for.